Hey Rob, how are you doing today?
I'm fantastic. Good to see you guys.
Joining us.
Absolute pleasure to be here. How you doing this morning, Jackson? Well, I guess it's barely afternoon. How you doing?
I'm doing well on my end. Thanks for asking. And I think we've got everyone up on stage, Alec.
Perfect. So we can get started. Thank you everyone for joining. We've got a really exciting space for you today. We've myself, Alec Beckman, as your host. Co-hosting is Jackson Blau and Noah Pollock, as always. Video team. Also have our own chief economist, Robert Murphy. But the real stars of the show are going to be Rob Montgomery, who's the CEO of Revest Finance, and they are bridging the gap between traditional and digital assets through the offering of on-chain yield factoring facilitated with financial NFTs, as well as Peter Gaffney, who is the head of research at Security Token Group, who is providing comprehensive tokenization research and advisory solutions to the greater capital markets, including clients and prospects in the asset management, private equity, private credit, commercial banking, ETF, and mutual funds and infrastructure segments. So thanks for joining us, everyone. Today, we're going to be really speaking about real-world assets, specifically collateralization and liquidity, and also institutions. So we'll start with Rob from Revest. Rob, do you want to make a quick introduction about yourself?
So my name's Rob. I'm the founder and CEO of Revest. I got into this space way back in 2012, bought my first Bitcoin in 2013, and finally went professional in 2021 when I dropped out of my doctorate in nanothermal engineering to go into crypto and digital assets full time. I've been building Revest for quite a while with my team, and where we have ended up after building an awful lot of things that kind of form the substrate of what we do is we've realized that there is a large gap in the world of asset management for tokenized digital assets. What we see in the space right now, it's very risk-on, it's very degen, but there's an awful lot of people out there who would be able to get exposure to crypto and digital assets without the possibility of seeing, all their money go to zero at the drop of the hat. So with Resonate, that sort of high-risk, low-risk structure, which is a terrible one, I'll get into what we actually do a little bit down the line, that's what we've been building. We basically built a system where you can borrow against the future yield on your U.S. treasuries, and then you can take that borrowed yield, deploy it anywhere in crypto or DeFi, take out your 100x levered perp on Bitcoin, and best case, you quadruple your returns on treasuries. Worst case, you lose your interest and get your principal back at the end of whatever duration your treasury has on it. We're working with an awful lot of tokenizers to make this a reality, and we should have some interesting news later in the day. Not sure I could talk about it just yet, but some very interesting goings on.
Perfect. And then I'll turn it over to Peter Gaffney to a quick intro to him, Security Token Group.
Yeah. Hey, everybody. Alec, thanks for the invite and hosting, and Rob, good to connect with you here. Great intro and great to hear a bit about Revest. Peter Gaffney, head of research at Security Token Advisors and Security Token Group more broadly, one of the original advisory consulting and research firms in the space, and we kind of built up the research that kind of as an industry agnostic and markets agnostic research player in the broader tokenization space. And so clients on the advisory side, to date, somewhere between 40 and 50 total, really on the real estate side on kind of fine art, carbon credits, and ESG products. Last, let's call it 2023 as a whole, way more institutional focus on the asset management, the credit, private equity side, and then even on kind of the public side with ETFs and fixed income products that are coming to market. And so a lot of players will kind of use us as either white label research teams, general consulting and advisory firm, and then different players kind of on the branding side. And so we work with all the different service providers. Rob, I'm sure there's a way we can work with your platform. And if you're looking for different issuers or kind of the integrations and connectivity, we'll definitely chat about that. But really just kind of bridging the gap between a lot of the different siloed solutions, the distribution channels where the actual buyers of demand are, and kind of, looking at different issuers and asset classes and how they really apply on the retail and institutional levels.
Perfect. And then a man who needs no introduction, but I'll turn it quickly over to Bob Murphy, For those of you who don't know him, he's our chief economist. So, Bob, do you want to give a quick intro about yourself?
Sure. Yeah, I was a college professor working in the Austrian economics tradition. Then I got into working with whole life insurance and helped develop a training program to teach financial professionals how to use life insurance for cash management purposes. And then Cole Snell, the founder of Infineo, recruited me to say, hey, we're taking all what you're doing with whole life insurance and putting it on the blockchain, and that's what we're doing at Infineo. So this conversation we're having today is right up the alley of exactly what we're doing here at Infineo too.
Rob, I had a question for you regarding Revest and Resonate. But I kind of let it pan out to begin, and I was wondering your take on the whole real world asset sector right now. Kind of less so in terms of it's real world assets and more in the the price actions of having all these real world asset tokens. I know a lot of them are kind of nonsense, a lot of them are real. If you don't mind talking about your opinion on the sector in general, and also the current price action on the tokens.
I think the sector is I would say that it's fairly nascent, but has a lot of promise. I think that expectation, that understanding is what is driving that price action. That aware that groups like BlackRock and JP Morgan are now eyeing ways to move capital into the blockchain. That awareness that we are finally seeing the financial infrastructure coming to fruition that is really needed to actually effectively tokenize assets. The absolute Cambrian explosion of tokenizers that we're seeing. And I mean, as someone who works with tokenizers, I see an awful lot of tokenizers springing into existence. And they all have different methodologies they're using to tokenize the assets. They all have slightly different approaches to what segments they're targeting. So to me, just talking about the recent, where the sector is right now, I think it's very early. There's a lot of people who can tokenize assets now, but there's not a lot of things to do with those tokenized assets, which is where we're trying to come in, where we're able to, offer our services on collateralizing the future interest on those assets and letting you borrow against it. Overall, I've seen a few money markets. I've seen a few marketplaces springing up. Mostly what I've seen is people who do the tokenization, which is, of course, a necessary first and an absolutely huge development for the sector. In terms of where this current crop will grow, I think a lot of them are probably going to end up having a sub-ideal tokenization methodology. I don't think that we might have one explosion, but most of them, it just won't be an ideal fit. The ones that I think have the best fit are still pretty early in their development cycles or their release cycles and haven't become widely known quite yet. But once they do, I think that they're going to capture large shares of the market, and then you'll have your definizers. Now, who those guys are mostly servicing right now is, of course, going to be your family offices, your donative hedge funds. So far, we're not actually seeing a huge lot of institutional capital entering the space. We have seen that beginning with the work on Avalanche lately, where we saw JP Morgan sending tokenized capital around DaveX. I myself, a few weeks back, ran into some BlackRock representatives, and when I asked them what they were doing at a conference, they responded that they were interested in putting a few $1 trillion on chain, and that was quite a surreal moment. But in terms of the overall sector, it's very early. A lot of the tokens out there will not perform in the long run. A lot of them are, shots in the dark, half-baked ideas. But there is a decent cluster of stuff that's been very quietly building during this bear market and is about to come out absolutely swinging. Well, in my opinion, if it has a long-standing token, I, of course, am the exception to this, but if it has a long-standing token, or if it's a brand new token, right now, the best RWA projects I'm aware of don't have a token. Except for me, of course.
Yeah, no, that's definitely something I was curious. That's something I've noticed. A lot of the products don't have a token. Peter, I was wondering your take on the kind of the sector as a whole, and you could dive a little bit more into kind of possible utility for the RWA tokens. Because, like we just said, a lot of the projects don't have a token. I was wondering if you see a need for utility in a real world asset token.
Yeah, I tend to agree with the last point Rob just mentioned around a lot of the quality ones don't have tokens right now. In my opinion, I don't see a lot of reason to have a utility token. Like I see kind of these overnight RWA protocols, let's say. Now there's another utility token to buy to interact with the protocol. A lot of that, in my opinion, is unnecessary. You already got big chains with established communities and networks that are integrating with a bunch of different transfer agents and dealers and alternative trading systems or different regulated marketplaces globally. And that is where like the institutions are going to play. I think a lot of the Web3, like the DAOs and even Web3 companies are looking at more utility token based products in the RWA space. But when you're talking about like what was mentioned before, when you're looking at Blackstone, when you're looking at major asset managers, everything they're doing has to be kosher to the very end. So, you know, a lot of what we look at is really on the compliance side, and a lot of these products on the RWA side may not need to be issued as securities if they're like raw NFT based loans and individual products, but the vast majority that are going to come on from the institutions are going to be done with regulated brokers and you know, licensed entities. So to that point, really see the existing landscape kind of being dominated by like Provenance blockchain, by Avalanche is doing a great job on in different layer twos. Base has no token right now and obviously have insane distribution capabilities, which is really the one need right now in the market. Like there's no shortage of people who want to put assets on chain. There's definitely a shortage of where the actual buyers so that I can fill my $10 million bond, you know? So I kind of look at groups that have distribution first and then work backwards from there.
I think that makes a lot of sense, Peter, and that actually kind of sets me up to ask another question that I'm really interested to talk about in terms of tokenization of real-world assets. Just looking through your Q3 report, 2023 most recent report, for anyone that hasn't read that, I highly advise that you do. It has all the latest that's going on with institutions and real-world asset tokenization. And in that report, you note that the tokenization of Treasury specifically has almost creeped up to $1 billion. And I just know that's a really interesting topic for Revest as well. But I wanted to just talk about the main use cases you're seeing for tokenizing assets right now and whether you like them or you think that there's room for improvement on them.
Yeah, I think the money markets and treasuries is a great Trojan horse. I think I look at it really from a portfolio construction point. Like the industry kind of starting at alternatives like real estate, private equity, pre-IPO shares and whatnot. And that's amazing. That's the ambition, you know, for everyone to be able to invest in these alternative products that you're not really finding in traditional channels. But the reality is a lot of those are, you know, kind of siloed off solutions and really one-off products instead of finding, let's call it programmed buyers or kind of repetitive recurring buys. Whereas when you look at it, you know, the end vision is to have an end-to-end, not to use the word end too many times, but an end-to-end digital interface is what you're looking for. And you can only solve for that so much by, you know, accepting ACH or wires or cash transfers. So I see a lot of these asset managers and even service providers themselves becoming an issuer, offering a money market fund that allows users to, let's say, convert cash or convert stablecoin into this money market. And the way I see it, as soon as you're in that money market or treasury fund, you're in their digital system. And now is new alternative offerings in like the real estate side, the PE side, private credit, whatever. As things become more available and become more progressive, now you can easily rotate from yield generating money markets, treasuries, and equivalent, you know, fund products into these alternatives. And that's really where you'll start to see more precise portfolio management, which is what I think a big value of tokenization is. Because it's great to see even, you know, a lot of the products that are issued with like securitized with different companies that are broker dealers are submitted to qualified purchasers, which leaves the vast majority of individuals out of the picture. But the real thing to look at is like, if I have a private credit product with Hamilton Lane, like the minimum buy-in is like $20,000 on securitized. Alternatively, the minimum buy-in is $2 million traditionally. So even if I'm a QP with just $5 to $10 million, like I can't justify putting a fifth or more of my capital into one product. So, okay, I could look at the tokenized version. Maybe I'll throw even $100,000. Maybe I want to reallocate and hit certain targets for my clients that only need maybe $500,000. So that's the perfect use case for them. And then eventually, as things maybe become listed on exchanges or retail-enabled marketplaces based on disclosures and legal filings, because at the end of the day, we still have to obviously go through that channel, then retail will get their shot.
Thanks, Peter. And I think what we'll do is we'll turn the same question over to Rob, and then we're going to invite Sean Risto from Figure to hop up and give his thoughts as well.
So in terms of where I see the tokenized treasury markets going, how I see them, that is the question, right? Where are they going? All right, I'm going to assume that's the question. So right now, the most interesting thing I see in the tokenized treasury sector is what I'm pursuing. And what I'm pursuing is a new form of treasury management, a safer form of treasury management. I've seen an awful lot of people make the mistake of holding their treasuries in ETH And I've seen an awful lot of crypto adjacent firms holding their treasuries in US treasuries off-chain. While I know, that there is a middle ground between those two, because one is, they're not taking on any exposure to digital assets. The other has way too much exposure to digital assets. And so my angle falls right in the middle, where you take the component of a yield-bearing asset, in this case, a US treasury, and that treasury has several benefits that a stablecoin farm, for instance, would not have. That treasury is KYC AML'd. That treasury is held off-chain, which is basically eliminates, for all intents and purposes, the risk associated with smart contract risk. And then you also do not need to worry about something like custody, because the treasury is also, in most of the solutions I've seen, being properly custodied in something like BNY Mellon. Now, what you can do from there, at least using us, and borrow against the future interest on the treasury, and then go ahead, deploy that into whatever you want, whatever high-risk position you want, all the same while you now have Bitcoin exposure, but you're still custodially compliant, and you still are principal protected. So we see the treasury market as a sort of way to route people who've been wanting to get into digital assets, who are holding most of their, balances in U.S. treasuries or cash equivalents. We see it as a way to route them into digital assets through that principal protected vector. Now, in the long run, I think that once we have even more advanced tokenization systems, and right now we've been seeing a lot of people tokenizing money markets, we're seeing some very early moves into tokenizing the individual duration matched assets, which I think is the far more interesting of those two options. Once we see that really explode into the scene, I think it's going to create a very interesting world where you have what I think Peter was alluding to, which is retail-facing on-chain money markets. I may have misinterpreted what he's alluding to, but that's where my head is. And the way I see it, you have these assets that represent different fixed income positions, different outlooks. And in a normal world where you're money markets, you actually have a hierarchy that dictates what the composition of a given money market portfolio should look like. But in a world where tokenization has advanced to a sufficient point, even just starting off with treasuries, you can actually set up effectively a Hunger Games of money markets and have different managers ranked on their performance, thus allowing someone who might have been at the bottom of the traditional hierarchy to rise to the top of a leaderboard just by being ever so slightly better at managing a portfolio than others. So, in my mind, treasuries are both a way that people with institutional capital can step outside of the walled garden that is the traditional financial world through utilizing borrows on risk-free components of that asset. And they are ultimately a way that we build the existing financial system into a more agile, reactive, and data-driven environment over time.
Perfect. And I'll turn it over to Bob really quickly. Dr. Robert Murphy from our team, hearing what Rob just said about treasuries and more fixed income type assets, can you kind of relate that to what we're doing at Infineo with whole life insurance as a fixed income alternative?
Sure thing. So yeah, we've been, I have a white paper that we've written up to, we just call Sound Beats Bonds. And yeah, the specific idea behind that is that we think once as the space develops more, that it's going to just be a no-brainer for people who are large institutional money managers who are sitting on a lot of treasuries, for example, or other comparable income assets, that getting tokenized access to a pool of, for example, whole life insurance policies, where what you're getting access to is the growth in the cash surrender value. So the underlying asset's extremely safe, and similar to what Rob is saying, that you don't know exactly what the growth is going to be, but it's fairly predictable within range, within certain bounds. And then some of the benefits, just to be real quick, as to why might you prefer that type of asset rather than just sitting on a bunch of treasuries, is the huge that's very relevant right now is that you don't have interest rate risk, right? So for a whole life insurance policy, if interest rates go up, the cash value in your policy doesn't go down, even though the carriers themselves are ultimately sort of backstopping those policies because they've invested in a lot of assets on their books, many of which include traditional fixed income. And so from the end user's point of view, that's one huge advantage. And then we have scenarios where we think the growth rate, especially in the long run, is much more attractive for whole life rather than treasuries, let's say. So you sort of get extra return, and then a lot of the risks are mitigated. And I'll just say one last word on that, just because it's interesting how it works out that we realize that life insurance companies, even though on their asset side they're holding traditional fixed income, so you might say, okay, so aren't you just kind of deferring or spreading, putting the risk somewhere else, and are we worried the carrier is going to be in trouble then? At the same time, though, the nature of their business, their liabilities are denominated in future dollar liabilities as well. And so from the carrier's point of view, yes, if interest rates spike all of a sudden, the value of their treasuries and other commercial paper and whatnot, that can go down. But at the same time, their liabilities also go down because their liabilities consist of a bunch of people, they have to pay death benefits to when they eventually die. And those are in fixed dollar. So that's just one way of showing that we think, as we explain this to more and more institutional money managers, that it becomes realistic for them to easily get in and out of this as an asset class, that, yeah, they're going to realize, oh, yeah, let me reduce my holding of traditional fixed income and expand it to this other area that, this company Infineo is providing me. So that's kind of what we're working on our end.
Great. So hearing this, and Rob, I want to kick it back to you. With the technology that you're building at Revest and Resonate, how do you see, assets, or how do you see going on to different assets that you're working with currently, whether it's life insurance with what Infineo is working with, or, other assets like real estate or art, or different things?
So with Infineo in particular, my primary interest, without a doubt, is in, so from a fixed income, there's two things I'm interested in with Infineo. The first is fixed income. The way that they're structured, their products, they are fixed income products, and they can be used in our system in the same way that a tokenized U.S. Treasury can be used. It has a guaranteed future payment based on the structure of the asset, and we can allow people to begin that future payment to get capital today to go risk on without risking their principal. So that is the most basic implementation of things that we have in common. The one that really, really interests me, though, is the potential for ultimately having these policies have their asset management on chain itself. So should Infineo move into that sector and begin to accrue this to accept this capital on chain, keep the capital on chain in U.S. Treasuries on chain, simply because that's the native sector and avoids any cost between moving on and off. Well, in that case, I'm very interested in the applications of our technology to being able to manage their portfolios, to be able to take whatever they have, allow them to receive that future interest today, and then go utilize it in various delta exposed positions in ways that they would not otherwise be able to, picking additional profit and then passing the reduction in premiums on their users, or just picking additional profit then. Now, in terms of the fixed income sector as a whole, I actually see the next logical leap being municipal bonds from U.S. Treasuries. They're still big ticket items. They are still quite standardized. And to me, that seems like the next logical leap. From there, I think we're just going to see an explosion. It will have to be NFT driven, mind you. That's actually something we worked on very early in the history of Revest, is financial NFT engine we pioneered. And the concepts there, you need a non-fungible position to represent a non-fungible fixed income asset. These assets have different, once you get into real estate, once you get into auto loans, once you get into, something even like an MBS, or even a basket of them, it's still something that has, a certain duration and a certain rate that those things are going to be grouped by. So we will need to see some additional technological resources come along. We may end up building them ourselves, but to me, I'm definitely very interested in the long run in getting more involved with things like real estate and auto loans. In the shorter run, things like municipal bonds and treasury bonds are definitely more fungible, which makes them easier to work with from an interest perspective, just because there's more liquidity on them.
Perfect. So then I'll turn it over to Peter again. And my question to you, Peter, is, what are you seeing in terms of some of the assets that are resonating with more institutional focused groups in this space? And is there anything you're really excited about from an asset?
Yeah, I think the other segment that's really taken off and taken wrong footing this past year is just general asset-backed securities and like HELOCs and mortgage assets. That's something that I think, just based on different yield profiles and frankly, on regulatory standing, it's tough right now in the U.S. to have fully native or on-chain private funds. Not everyone yet has that solution, but asset-backed securities and HELOCs can be originated on-chain, and now you're kind of in that whole end digital system. So to me, that's just a sector that's really caught some steam. I know Figure's already hit $1 billion in Q3 alone in new originations. I think total they're probably pushing $10 billion. Definitely a sizable piece of the market, maybe something like 6 or 7%. But that's just me talking. Like I said, the money market stuff is great as a Trojan horse, but really we're still seeing the end goal is really either these asset managers trying to develop their infrastructure pieces to go direct to REITs, kind of like what you're seeing with Wisdom Tree Prime and their digital 1940 Act funds, or others just figuring out, what consortium to join and how they kind of ride along with some of their peers, if you will. It's kind of funny because you always think these investment banks and asset managers are super competitive, but in this industry right now, it's definitely more of a collaborative field. And that could kind of just range from digital bonds to, real estate portfolios and offerings. Again, the tough part isn't the product. There's no shortage of that. It's really finding buyers. And of course that comes with the mechanics of investing and finding real risk return profiles, but also, who can make it most seamless for their investors to onboard and to manage. And that's where I think there's a little disconnect between kind of the RWA protocols and what institutions frankly need in their controls and their compliance to work with.
Great. Rob, if you wanted to add on.
Yeah. I had a thought right after you guys. What other sectors are you interested in? Are you excited about? I would say another sector that I'm personally excited about. And I'm not going to say, what my long-term plans for it are, but we're obviously doing yield factoring. We're allowing people to receive their yield upfront today. And we borrowed that term from the factoring industry, which is extremely prolific in trade finance. To me, that sector is absolutely fascinating, both from the perspective of the next developments on chain, bridging that real world on chain gap, and from the perspective of regulatory considerations. Because in most circumstances, and just so everyone here is clear, factoring an invoice is where you have an invoice, say you're a trucker, and you have delivered a load of goods. You want to get paid today, not in 30 days, so you sell the invoice to a company for a 1% to 2% discount. That's an extremely high rate of return for the people purchasing the invoices. But what's most interesting from a regulatory standpoint is that that's not actually considered a security because it falls outside of the mandate for security, I believe, is 270 days in most circumstances. Don't quote me on that, I'm not a lawyer. But that makes it an industry that is ripe for disruption by on-chain RWA developments, just simply because it doesn't have as much of a regulatory hurdle as some of these more traditional asset classes like mortgages or auto loans or even, U.S. Treasuries do.
Thanks, Rob. Just kind of following up, going to different assets and what we were talking about before, liquidity. One thing I've noticed with this space, all growing spaces, is liquidity issues. I was kind of wondering, both Peter and Rob, what your thought were on the future of kind of omni-chain lending and different assets in the real world asset space. I know right now the few kind of omni-chain protocols out there aren't being really used that much. But I think everyone agrees we're not going to be in an only EVM future. There's going to be lots of chains do lots of different things. And I was wondering what your thoughts were on those chains communicating, and especially in like treasuries, for instance, what your thoughts are on that.
Yeah, I think it's a great question, and agreed, it's got to be a multi-chain future, not just compatible chains, but kind of across the board. And there's multiple avenues to liquidity, and collateralization is definitely something extremely interesting to a lot of clients and to a lot of prospects that are issuing this stuff. The whole idea of tokenization is to make things more actionable, whether you have liquid assets or assets that are kind of the future in the trade finance side, like Rob mentioned. You want to make them more actionable as you can. And the more velocity with assets, I think the strategies that managers and players on the buy and the sell side can kind of control or kind of create and work with, which of course is the name of the game, as things get more and more commoditized in the financial services side. In terms of execution and what we've actually seen happening, there may be more happening on the retail side than I'm aware of. Really, the institutional side is everything's going to be kind of cut off from retail. Like think of Avalanche and their subnets or Provenance and their zones. That's kind of how they brought the deal together, both those blockchain foundations with like Apollo and JPM and Wisdom Tree recently, a couple or 3 weeks ago. They're going to be really siloed between retail and institutional until the tech and the compliance especially is locked and loaded. And even at that point, a lot of the institutional collateralization or liquidity promises that we hear are really going to be just new controls kind of for the portfolio management team whether it's asset management or wealth management groups or even private banking clients. But that's kind of what I focus on lately, so I can't speak very much on the retail side.
So I will split hairs a little bit on the EVM component. I actually have a strong view that it will be EVM chains that become dominant, like Avalanche, for instance, or anything built off of Ethereum mainnet, which is highly modular. And I hold that view. My original role in my company was both CEO and developer, and I'm quite familiar with development. Once a language has become dominant in a sector, it is impossible to supplant it. Other languages can spring up and grab market share, but Solidity has taken over the Web3 sector. If you, as a new developer, want to get into programming in digital assets, you will learn Solidity. The same way that you, as a web developer, your first language will undoubtedly be JavaScript, just because there are a ton of jobs that will pay you money for knowing JavaScript, and there are not as many jobs that will pay you for knowing Python. Same holds true for Solidity. Chains that have their own, esoteric languages, unless they figure out a way to transpile Solidity to that language, they are going to have trouble getting that widespread adoption, just because most developers are relatively lazy and only really want to learn 1 or 2 languages for a sector rather than, 3 to 5. And the ones that learn 3 to 5, they want to be compensated significantly more for their effort. You can find Solidity devs at every college across this country, but you can't necessarily find someone like a Cairo dev, which is ZK Sync's proprietary language. So to me, I think EVM chains do end up on top, and the chains that don't have EVM, people like Rust, Solana, which their Rust dialect, that'll probably be a secondary, the same way Pythonic languages are secondary for web development. But you're always going to have an easier, cheaper time building a system, building it in Solidity than you will in any other. Now, as the liquidity problem, at least in the small to medium level institutional sector, and I'm not talking about the big boys like JP Morgan or BlackRock, I'm talking about the smaller guys, the family offices, the hedge fund, the guys who are already here or looking at this sector kind of greedily, the people who are in the top 200 asset managers on the planet, but maybe not the top 50. To me, the way that we go about this is we build systems that are asymmetric, and that's how we bootstrap liquidity. The example I give for my own system is Resume. We allow you to borrow against only the interest on a position. If you have a 1-year treasury, that's currently about 5%. And what that means is that the lender only needs to have 1/20th of what the borrower is bringing. If the borrower was up with $1 billion, the lender only needs to have 50 million. $1 billion is very hard to find liquidity for in this space, but 50 million, that fits into the current ecosystem. That fits into what decentralized finance and the surrounding sectors have built already. You'll be able to find liquidity on that quite easily. Now, the interesting component becomes we also issue you a packet, an FNFT that represents your principal, your rights to reclaim your principal at a future date and time. And you can take out a loan on that too. You can sell that. And that then creates, this basically solves the chicken and egg problem of liquidity, which is, okay, I want to bring $1 billion on chain, but I don't have somebody as a counterparty who has $1 billion on chain. Well, bring $1 billion on chain, get a counterparty who has 50 million, and now there's $1 billion on chain that is just sitting around waiting for somebody to show up and do something with it, something for it. And that cycle that normally is a complete circle, there's no way to break in, it now has a beginning point, and we can start from there and spiral outward, rather than just being stuck with which one do we start with first and not being able to get either. Finally, I do think we will see the biggest players in the SEC coming into this space, but I actually think the biggest drivers are probably going to be those mid-level guys. Historically speaking, when we look at the disruption of industries at a fundamental level, the biggest players actually rarely survive. And I'm not saying that that's happened, but if it's a fantastic book. It's called The Innovator's Dilemma. And one of the case studies, it's actually pretty classic, and I think they even teach in business school. One of the case studies is Caterpillar. When Caterpillar showed up in the construction industry, which is an absolutely massive industry worldwide, everybody and across the world was using cable-based construction equipment. If you had an excavator, you controlled it with cables and a winch. had a lot of winches, had a lot of moving parts, expensive to repair, expensive to run, and Caterpillar showed up with the hydraulic piston. They were the very first company to do that ever. What ended up happening is every single one of those companies who existed prior to the arrival of Caterpillar went bankrupt, save for 2 or 3 who survived by specializing in the only construction equipment that uses cables anymore, which is the tower crane. The rest, all the big players, completely wiped out because they weren't able to adapt fast enough to catch up with Caterpillar. And the possibility here is that when a new innovation shows up, the middle guys are the ones who, if you have a hierarchy, the guys in the middle are the ones who will jump ship from the guys at the top and go over to new innovation because they're agile, they want to save money. The guys at the top are a bit slower, a bit harder for them to adapt. And so I'm not going to say they're not going to make it, but I will say that I view the development of the sector as these, it will be slow, but it'll be faster than people think, and it won't be driven by the people who everyone expects it to be driven by.
100%, Rob. And I think that's a great point you make there. And actually, we'll transition really nicely into some insight from Peter, as he's really been on the ground in the tokenization space for a while now. And so, Peter, I'm really interested to hear your insights on Rob's comments and whether or not you feel that we've seen this exponentially increasing rate of institutional players entering the tokenization space begin, and whether you think these players are going to be around for a while, or whether you think they're going to be displaced by new, more visionary and innovative projects entering the real-world asset space.
Yeah, definitely. I think we see prospects all over. So like the top 200 asset manager reference is great, but also like things get super siloed out across sectors and focuses. I don't know if anyone's getting necessarily displaced yet, but I think it's like you can look at even ETF issuers, which is my background. You have a lot of those firms organization because they're seeing what protocols and platforms are doing for and wrapping ETFs and issuing, wrapping ETFs, holding them in trust and issuing tokens on that. And now it kind of begs the question, like, where's the future landscape going for us? It's going to be kind of the next evolution from individuals to mutual funds to ETFs, now to blockchain transfer funds or on-chain assets, whatever, nomenclature you want to work with. And then even on the asset management side, like, these are just products they have to use at or can start offering themselves. Like the most at risk, if you will, are going to be broker-dealers and investment banks. And people kind of have this misconception that you can just issue a token and over to raise the 20 million you want or the 50 million, 100 million for your product. And as unreal as that would be, if that was the case, trust me, it would make our jobs a lot easier. Being able to have that validity, you still need really good placement agents. You still need really good brokers that can find proper investors to meet your criteria and your profile. In a world where there's so many similar profiled offerings, especially even like in the real estate space or even startup companies when they try to raise capital for equities. Like, look at our space alone. There's so many companies doing similar stuff. You really need to have that help and that boost. And frankly, just the banks and the incumbents have that network and that deep bench of investors. So that's why the big firms, even to use Rob's language, like the top guys have their own platforms. And I agree, I think little market firms, if you will, are either joining consortiums or kind of looking at one-off deals. We talked to a few of them, and even there's a couple that are underwriting IPOs in the space now, planned for 2024. I think they're all going to start making their mark one way or another. And even in, I don't know if it's in this Q3 report, but maybe in Q2 or Q1, we say, like, you don't have to always create your own platform to get involved in the space. Like, if you're an investment bank, a boutique, all it takes is you being willing to work with a tokenized deal, a tokenized placement to help raise capital, and suddenly your name is now part of the industry. And that's how I think I see a lot. And Rob, to your point, you're absolutely right. Those who don't adapt are going to fall off. And that's where I think you'll see the innovation come. Everyone's got an innovation desk these days, but you'll really see who's actually innovating with that desk and who just kind of has it in name.
And Peter, that's really, really helpful there. And I think just for the listeners, what might be even more helpful would be, do you have, like, to talk about potentially an example of one of these institutional deals that has done a good job and what you really liked with it? Whether it be from your Q3 report, Q2 report, or any of your other articles or mediums I know that you're writing. Is there a specific example of a tokenized deal, company, a one-off thing that has worked with the right people that you've been really inspired by?
Yeah, I mean, I could name a couple here, but even straight from the top, like the gold standard, no pun intended, like Goldman's digital asset platform. I think they know their focus. They're not looking at retail, they're at small issuers, but they realize tokenization and even working with the private chain in the meantime, is just kind of the next technology overlay. You know, you don't always have to go 0 to 100, looking at the DeFi space, but for now, they're actually issuing digital bonds. They save like basis points on their 100 million euro bond, I believe it was, issued by European Investment Bank, EIB. And that's only 150 grand. In euros, let's call it 170 grand, which is not much. You know, you could throw a little extra bonus to your analyst team with that, if you will. But that was a single kind of proof of concept type offering that brought their platform live. So just imagine doing that at scale, or even just with a bundle of different bonds. And that's when you can really start to see economies of scale. That's when your 15 bits suddenly turns into 35 bits of savings. Your 100 million euro bond suddenly turns into $1 billion. And now look at what you're saving. And what they did with this one was pass that 15 bips of yield on to their buyer, which was Union Investment, maybe not 100%, but pretty much like 99% of the bonds subscribed by them. And that's tangible, you know, as a money manager, that's doing your job. You got to scrap for yields for bips. And so, you know, people in the capital markets to ignore the possibility here is ridiculous. And even when you look at it from the asset management side, like you're a fiduciary, if you're ignoring the stuff, and this is very popular when, you know, even a few years ago in digital asset space, as a fiduciary, you should be educating yourself on this. But even, you know, with tokenized products, you need to know what this technology is doing for the total return of your assets, pretty much. And even like if you look, just as another example, not to keep rambling, but if you're looking at another thing on the sell side, like Broadridge is a legacy trend agent, and they underpin so much of the plumbing in capital markets, whether it's the ETF side, the private markets business, stocks, bonds, whatever. They're on chain. It's called their distributed ledger repo system, DLR. And like they've been working with Societization around UBS and HSBC and a couple other firms, but SocGen is saving $1 million for every 100,000 transactions. Now, I don't have data. I'm not plugged into how often they're really transacting. But I mean, repos do an absolute insane amount of volume on a daily basis. So we can expect $1 million per 100,000 transactions that'll only scale upwards over time. And again, that's tangible money that you can't be leaving on the table. So I kind of see that too as two angles. You know, you could be kind of like a service provider on the sell side, or starting to offer tokenization as a service to some extent to your big clients and save them money, or you could be an issuer or a buyer and also look to negotiate some of that pass-through that's come in excess.
Perfect. Thanks, Peter. So what I want to do, since we're getting close to the hour here, I wanted to ask Rob and Peter just to give their thoughts as a one last question, just to give your thoughts on what needs to happen for real-world asset adopt, and it's kind of what you see that's giving you some hope that you know, as we approach more of a potential bull market, how we can bring users into the space. So I'll start with you, Rob.
So I would say there are two things that really need to see RWA just adoption explode. The first of these is just better regulatory clarity. The regulators working more with us, to be specific. I know of some people who have been structuring RWAs in absolutely fantastic ways, but are, despite it being fully within the confines of the law, getting hamstrung by the SEC for the only apparent reason being that they just don't like them. So we need a more friendly regulatory environment, which I think we'll be getting in the next year or so. The other thing that I think will be a big addition to the sector, though personally I'm a massive libertarian, a huge OG Bitcoin guy, so saying this kind of kills me. But at the same time, for the institutional adoption, at least for institution transactions, we need to see a agreed upon and adopted digital identity standard. And I'm aware of efforts in this, thanks to some friends of mine, in the VLEI effort, which is the Virtual Legal Entity Identifier. It's powered by something called KERI, K-E-R-I, which I've been absolutely fascinated with lately because it is the successor to IDVC and appears poised for near global dominance based on the information available to me, at least in terms of what is going to be the standard that people use. Unfortunately, for those of you listening, no token. But I think that once we have that, it will be very, very easy for institutions to overcome a lot of the double KYC, triple KYC, quadruple KYC they're having to see on a platform by platform basis, just because now everybody has a standard that they agree on.
Awesome. And Peter, same question to you. Can you talk a little bit about adoption and, you know, what you think needs to happen?
Yeah, I mean, mostly basing this off kind of what we're interfacing with our clients and prospects and their feedback, especially. There's a couple things. One, I don't want to use the cop-out answer about like compliance and onboarding, because companies like BitGo and partner with some companies, and they're upgrading their wallet standards to allow for multiple signatories and different compliance tailoring, if you will. That's definitely a piece. But I think a lot of the players in the space have kind of addressed that pretty well. But really, it's not what I was saying earlier. In this space, the demand side just has to be there. You can issue as many products as you want. I could issue 100 tokenized offerings, but if no one's buying them, then really, what am I doing? So I'm really looking at, and that's what we're kind of talking with a lot of the banks and distribution channels, like figuring out how to onboard and work with different RI wealth management, even private banking standards, is the hindrance right now. Because a lot of business, like these legacy asset managers, even goes back to their custodian and their fund administrators. And if you're, that's the real plumbing that connects the capital. At the end of the day, it's not as simple as going from phone call to phone call and moving all the size. And so that's really what needs to be addressed. All these service providers offering tokenization and different products to come to market, but they're kind of creating their own little bubble, and it's hard to move capital into that bubble unless you kind of pay the troll, if you will, to use an Always Sunny reference, and figure out how to connect to some of these legacy fund admins. Even talking this morning to Calistone, who's much a non-U.S. fund administrator. They are working pretty deeply to tokenize not even just fund wrappers, but really to tokenize underlying assets. And they see that. I don't know if I should speak for them and say they're seeing a ton of demand, but they see that as kind of where the future is headed. So when you look at different companies like that who really connect to who act as a distribution channel, that's what I like to harp on in conversations these days. I've definitely learned, my lessons from when I joined the space to now. You really have to kind of work backwards sometimes and find the capital first, and then revert to the actual issuance.
Amazing. So thank you, everyone, so much for listening. This was a great session. Really want to thank CEO of Revest and Resonate, Rob Montgomery, as well as the head of research from Security Token Group, Peter Gaffney. And then, joined by my amazing co-hosts, Noah Pollack, Jack Howe, and one of our favorite recurring guests, our chief economist, Dr. Robert Murphy. We are doing this every single Tuesday. It's going to be at 12 p.m. Eastern. We're going to have amazing, it might be hard to believe because of how great these guests were today, but we're going to have incredible guests, and hopefully Rob and Peter can make it back on the stage. We can continue the conversation with them as well, because they were just unbelievable. So really quick, Rob, can you tell people how they can find Vest, Resonate, and yourself if they want to learn more or reach out?
Absolutely. If you're interested in Revest, I would advise you just go ahead and search RVST, the ticker, or go to revest.finance. Website's a little out of date, though, so you should probably, if you want to know more about what we're doing now, do resonate.finance. Now, finally, you want to find out about me. I hadn't really thought about that, but my LinkedIn's included on both pages, and you should definitely check out our Discord. Thanks for having me, guys. It's been a really good time. Enjoyed chatting with you all. It's been a lot of fun.
Perfect. And then, Peter, to you, where can people find you, Security Token Group, Security Token, and your reports?
Yeah, definitely. Thanks for having me on, Alec, and the team. Good to see all you guys. Rob, really just enjoyed the discussion, too. I'm on Twitter. I get a little more active than digitally, but mainly LinkedIn, just Peter Gaffney. And securitytokenadvice.com is our main page. We track a lot of the secondary trading data across different ATSs and regulated venues at stm.co, if you want to check that out. And then a lot of our research flows through my LinkedIn personally and on that STM page. So that should kind of get you everywhere you're looking, and always happy to chat about different tokenization projects, as we do have our advisor consultant on, not to be a sales guy. But yeah, that's kind of, thank you so much for having me on as well.
Awesome. And then I will also say that we have a podcast every single week that's hosted by Dr. Robert Murphy. You can find that on the Infineo YouTube page. If you also want to learn more about Infineo and what we're doing, feel free to go to infineo.ai, where you can learn more. Obviously, you can reach out to me directly. By the way, my name is Alec Beckman. I'm the Director of Digital Assets at Infineo. You can email me at alec.beckman@infineo.ai. I'm also on Twitter and LinkedIn. You can feel free to reach out to me there. But thank you everyone for joining us, and we hope to see everyone back next week. Thank you.
Thanks for having us. Y'all take care.